All right, let's be honest. Have you ever stared at a crypto chart with all those blinking lines and candles and just felt totally overwhelmed? Like you're trying to read a language you've never seen before? Well, that stops today. We're about to give you the translation guide. This is part one of our deep dive into crypto market analysis, and we're going to break down the signals, the psychology, and the structure you need to see this market with brand new eyes.
Here's the game plan for today. Think of this as our journey from reacting with our gut to analyzing with data. We're going to cover these 5 critical concepts step by step to build you a rock-solid foundation in technical analysis.
Okay, let's dive right in. Before we even look at a single chart, we have to talk about the most important tool you have, and that's your own mind. See, the market is just a giant reflection of human psychology, and mastering our own is the absolute first step to getting this right.
At its heart, the market is a constant tug-of-war between 2 massive emotions, greed and fear. When we see those giant green candles, greed screams, "Get in now or you'll miss out." And when things turn red, fear yells, "Sell everything." The analyst takes a deep breath, steps back from all that noise, and sticks to a plan built on data, structure, and confirmation. That's where we're headed.
Okay, mindset locked in? Good. Now let's get our hands dirty and actually look at the charts. We're going to learn the most fundamental and honestly the most powerful language of the market, the structure of a healthy uptrend. This is where we stop guessing and start reading what the price is telling us.
The absolute key, the bedrock of a strong uptrend, is this one simple concept right here, the higher low. It's so simple, but it tells you everything. It means that every time the sellers try to push the price down, the buyers jump in with even more force, and they do it at a higher price than last time. It's a crystal clear sign of growing strength and demand.
You know, the best way to visualize this is to just think of a staircase. It's perfect. Each low is a step, and each higher low is the next step being built above the last one. As long as the market is building that staircase up, we know the uptrend is healthy and intact.
So seeing the staircase is one thing, but as analysts, we're also looking for those moments of pure energy. After the price gets squeezed into a tight range, we call that compression, it's like a coiled spring. Eventually, it's going to explode in one direction. Spotting these breakout zones is how you catch the next big move up that staircase. So here's the million-dollar question, right? How do we know if that breakout is the real deal or just a trap, a fake-out designed to fool everybody? Well, we can never be 100% certain, but we can play detective. We can gather clues. And our first, most important piece of evidence is volume. So from now on, whenever you see a big price move, ask yourself this one simple question. Is the crowd coming with me? Are lots of people participating in this? Or am I at a party for one? The answer is usually sitting right there at the bottom of your chart.
And just look at the difference here. If the price is shooting up, but the volume was low, that's a massive red flag. It's like a cheer with no crowd. It means there's very little belief behind the move. But if the price is rising on a huge wave of volume, that's what we want to see. That's confirmation. That's the crowd roaring its approval, showing real power and conviction.
So volume gives us that in-the-moment snapshot of the crowd's belief. But what if we want to see the trend over time, without all the crazy daily noise? Well, that brings us to our next tool, the moving average. Think of it like noise-canceling headphones for your chart. It smooths out all the choppy price action into one clean line. And the rule couldn't be simpler. If the price is staying above that line, it's a great visual sign that we're in a bullish trend. Okay, we've got structure, we know how to look for confirmation, we're building our analyst toolkit. Now let's level up. Let's go big game hunting for the really major signals, those specific events that have historically pointed to massive long-term shifts in the market.
So, out of all the patterns out there, is there one signal that makes analysts everywhere kind of sit up and lean into the screen? A signal that might suggest a real long-term bull market could be starting? Oh, you bet there is. And it's one of the most famous patterns in all of finance.
It's called the golden cross. This is what happens when a fast, short-term moving average like the 50-day physically crosses up and over a slow, long-term average like the 200-day. Now look, no indicator is a crystal ball, but historically, this is a huge deal. It shows that the recent positive momentum is now officially overpowering the long-term trend, and that can signal a major shift is underway.
Next up, we have the RSI, the Relative Strength Index. So if moving averages are kind of like our GPS telling us the general direction we're headed, then you can think of the RSI as our speedometer. It tells us not just if we're going up, but how fast we're accelerating, and more importantly, if we're about to redline the engine. And what's really cool is how we read that speedometer. If you get a reading above 70, that's considered overbought. Now, that doesn't mean sell right now. It's more like a yellow light. It's a warning that the market's getting a little hot, a little frothy, and might need to cool down. On the flip side, a reading below 30 is oversold. That could be a sign that the sellers are getting exhausted and the market might be due for a bounce. All right, to complete our picture, we need to understand the playing field itself. All this price action, all these battles between buyers and sellers, they happen at key levels on the chart. We need to identify that battleground. And we call these levels support and resistance. The easiest way to think about it is as a floor and a ceiling. Support is the floor. It's a price area where buyers tend to show up and cause the price to bounce. Resistance is the ceiling, an area where sellers take over and reject the price back down. But here's the magic trick. Once you break through an old ceiling, what does it often become? It becomes your new floor. But I gotta warn you, the market loves to play tricks at these levels. It'll poke its head above a ceiling just long enough to trap eager buyers. That is why patience is everything. We don't chase that first little move. We wait for a candle to actually close above that level. That's our confirmation that the buyers have won that territory. Patience creates profit. So let's put it all together. This is it, your 4-step analysis checklist for every chart you look at. Number 1, identify the structure. Are we building that staircase of higher lows? 2, confirm with volume. Is the crowd roaring or is it silent? 3, check momentum. What's the speedometer, the RSI telling us? And 4, validate the move. Have we gotten a confirmed close above that key level? Structure, volume, momentum, validation. That's the framework. And that's a wrap on the fundamentals for part 1. You now have a solid framework for reading a chart with confidence. But hey, this is just the beginning. In part 2, we're going to get into the really crucial stuff, risk management and some more advanced indicators that will take your analysis to the next level. You are not going to want to miss it. Let's keep learning. Welcome back, team. So in part 1, we really hammered out the fundamentals. Now, we're going to crank things up a notch. If you thought that was interesting, just wait. We're about to dive deep into the advanced strategies, the risk management, and the market psychology that really, really, separates the pros from the pack. Let's get into it. So here's our game plan for today. Think of this as our roadmap. We're going to build a complete framework, starting with what is, without a doubt, the most important rule of all, protecting your capital. From there, we'll get into decoding advanced patterns, measuring the market's momentum, figuring out what the crowd is thinking, and then, the grand finale, putting it all together with a disciplined trading plan. All right, let's kick things off with Section 1, protecting your capital first. And look, this isn't just some friendly suggestion. This is the absolute bedrock of successful trading. Before you can even think about winning, you have to master staying in the game. So, let me just ask you this. What do you think is the single most important rule? It's not about nailing the perfect entry. It's not about calling the exact top. Nope. It's something way more fundamental than that. It's this, right here. Protect your capital at all costs. Think of yourself as a fortress, and your capital is everything you're defending. Your shield in this battle is mastering position sizing, and that means sticking to that hard and fast rule of never, ever risking more than 1 to 2% of your whole portfolio on a single trade. The goal here is longevity, not speed. You gotta survive first, and then you can thrive. So, how do we actually do this? How do we enforce this rule? Well, with a stop loss. It's your preset escape hatch, your financial safety net. But here's the thing. A stop loss isn't just a technical tool. It's a psychological one. It completely takes your emotions out of the decision-making process and forces you to be disciplined when the pressure is on. And hey, real quick, if you appreciate this focus on smart, defensive strategy, do me a favor and take a second to hit that like button and subscribe. It really tells us that you value this kind of deep dive analysis and it helps us keep creating it for you. Thanks, team. Okay, defense is set. Now let's move on to the offense. Section 2, reading advanced chart patterns. Now, we get to learn how to decode the stories that the market is literally telling us right there in the price action. And it all starts with understanding what a single candlestick is telling you. The body, the thick part, that shows conviction. A big green body means the buyers were totally in control. The wicks, those thin lines sticking out, they show rejection. A long wick at the top, that means sellers came in and slammed the price back down. Every single candle is like a mini battle between the bulls and the bears. Now let's see how these candles build into actual patterns. This right here is a classic continuation pattern called a bull flag. So you get this huge, strong move up, that's the flag pole, and then it's followed by this little period of consolidation, kind of drifting down, that's the flag. Psychologically, this is just the market taking a breather, shaking out the nervous traders, before, statistically speaking, continuing the move up.
But, trends don't last forever, right? So what about when a trend might be ending? How can you actually spot a potential reversal before it's too late? I mean, continuation patterns are great, but you've got to know the warning signs too.
And that brings us to reversal patterns, like the good old double bottom. This is a big-time bullish signal. It happens when the price hits a support level, bounces, comes back down to test that exact same level again, and fails to break through a second time. That is a powerful, powerful sign that buyers are stepping in with force.
The key thing to look for is that W structure. You can see it, right? That shape is just a beautiful illustration that the bears tried to push the price down twice, and they failed both times. That second bounce off support is the confirmation you're looking for, a signal that buyers are taking control and a potential trend reversal to the upside is on the table.
Okay, let's build on that. Section 3, Analyzing Market Momentum. It's one thing to see a pattern taking shape, but it's another thing entirely to know if it has any real power behind it. Is this trend gaining steam, or is it running on fumes?
This is where we use a really cool tool called Divergence. Basically, we're looking for a disconnect between what the price is doing and what a momentum indicator like the RSI is doing. So bearish divergence is a huge warning sign. The price grinds out a new high, but the indicator makes a lower high. That suggests the buying pressure is fading. On the flip side, bullish divergence is an opportunity. The price makes a lower low, but the indicator is making a higher low. It's like momentum is secretly building up under the surface.
Now this is absolutely crucial. Context is everything. You can't just stare at one time frame. The 15-minute chart, that's mostly short-term noise. The 4-hour chart gives you a good idea of the intraday structure. But the daily and weekly charts, that is where you find the dominant, true trend. You always have to start your analysis from the top down to avoid getting faked out by some meaningless little move.
All right, now for a really fascinating topic, Section 4, Understanding Crowd Psychology. We're going to shift gears from the charts themselves to data that actually measures the emotions, the feelings of the crowd.
One of the best tools for this is the Fear and Greed Index. You have to think of it as a contrarian indicator. When the market is in a state of extreme fear, like we're seeing here, it can often mean a bottom is close, because pretty much everyone who was going to panic sell has already done it. And of course, the opposite is true. Extreme greed can be a major warning sign that the market is getting way too overheated.
We can also look directly at the blockchain data itself, and it's actually pretty simple. When we see huge exchange outflows, that's coins moving off exchanges into private wallets, it suggests people are planning to hold for the long term. That's usually bullish. When we see massive inflows, coins moving onto exchanges, that suggests people are getting ready to sell, potentially bearish.
And finally, we can look at the overall market cycles. Capital usually moves in a pretty predictable pattern. First, money flows into Bitcoin and its dominance goes up. Then, profits from Bitcoin start to rotate into the big, large-cap altcoins. And finally, as people get more comfortable with risk, that capital trickles down into the smaller, more speculative projects. Understanding this flow helps you see what's coming next.
And all of this, every single thing we've talked about, leads us to our final and most critical step, Section 5, Executing Your Trading Plan. Because, look, all the analysis in the world means absolutely nothing if you don't have the discipline to actually act on it.
A huge part of that discipline is knowing when to take your profits. Don't just ride a trade up and then all the way back down. Have a system. At your first target, you sell a piece to lock in some profit and de-risk the trade. At target 2, you sell some more. Then you can let the rest of the position run with your stop loss moved up to protect what you've already made. This is how you make sure a big winner doesn't turn into a loser. So here's how it all comes together. This is your final analysis checklist. Before you even think about putting on a trade, run through these points. Is the market structure bullish? Is there volume to confirm the move? Has support or resistance held up? Do your momentum indicators agree? And, most importantly, are you in a state of mental discipline to execute your plan without hesitation? This is the kind of strategic thinking we break down here all the time. To make sure you never miss out on the latest market analysis and just keep leveling up your skills, go ahead and hit that subscribe button right now. Let's keep learning together. Remember, having a good system is what separates trading from just gambling. Now for the really important part. Please remember, this is not financial advice. This is for education and entertainment purposes only. You should always do your own research. Thanks for your time, team. I'll see you in the next one.